Hi, what a wonderful sight that was to see the birds and animals so happy and cheerful. They were so happy and cheerful probably because they don't worry about tomorrow. They live for the moment. But unfortunately, or fortunately, whatever you may consider, we human beings are always worried, or I won't use the word worried, I would say concerned. We are always concerned about our future. We want a future to be bright, and therefore we try to earn more and more. And when we earn more than what we can spend, we try to invest that surplus so that it grows further. And sometimes when we don't earn adequate, still we want to save something and invest so as to secure a bright future. What I'm trying to tell you is that the desire for investment is an inherent desire in all human beings, however rich or poor that person may be. And therefore, today we shall talk something about a logical and a knowledge based approach to investment. A word about me. I am Colonel Shabbar Shahid, an army veteran with a passion for teaching finance and management. I have several courses on Udemy. I am a postgraduate mechanical engineer, an MBA in finance, a chartered engineer, a fellow of the Institution of Engineers in India, and a doctorate in management. So you can trust me that I am qualified to speak on the subject. I look forward to see you through the course. So let us begin our journey for searching logic and seeking knowledge in our investment. The obvious question which will come to your mind is, what is the logic in investment and why do we need knowledge? So if you just look around, that you may find a person may be rich or a person may not be so rich. If a person is rich, then he will have money more than what he can spend. But if he is not so rich, then still he will be constrained to save something, curtail his spending, and save something for a bright future. Now, in both these cases, it will result in some unused money. Remember, I am not talking of those unfortunate people who find it difficult for their daily sustenance. I am talking of people like you and me. So if you are a person who is watching this video, then it is obvious that you have some unused money. And the biggest problem with we human beings is that what to do with this unused or the surplus money. Now, at a glance, if you just try to blink your eyes, you will find that you have broadly three options. One is that you can put your surplus money or your unused money in your locker at your home, or you can put it in your bank. And the third option is that you can invest that money. Again, if you think of investment, there could be several options in investment, but let us club all of them under one head of investment. Okay? Now, if you choose to put your money in your locker at your home, then this money will lose its value due to inflation. We all know that money kept in a locker over a period of time will lose its value because of the inflation. The rate of inflation may be different in different countries, but the money will lose its value. If you put it in a bank, then of course it will earn some interest. The money will grow, but it will grow very slowly. The rate of interest in a bank will be very low. But if you choose to invest your money, then there is no certainty. The money may grow, the money may not grow, The money can even diminish if the investment is not proper. If the investment is not with proper knowledge, then the money can also diminish. So the thing is that each of these options have their own pros and cons. If you choose to keep your money in your locker at your home, then of course your money will remain secure in the locker, but it has got all the risk of losing its value because of inflation. And if you choose to put your money in the bank, then of course the risk is negligible. The bank is quite safe and the risk of losing value is negligible, but the growth will be very minimal. Because of the low interest rate, the growth in the bank will be very, very less. But if you choose to invest your money, then you are subjected to risk and you also have the prospect of growth. But how much risk and how much growth? That is the $1,000,000 question. Now, you may have heard of that wise old saying that high risk, high return, no risk, no return. What does it mean? It doesn't mean that if you take high risk, then high returns are guaranteed to you. No, not at all. What it actually means is that if you are expecting a high return from your investment, then you should be prepared to take high risk. And if you are not prepared to take any risk, then you should also not expect any returns. So what is the logic that we are talking about? What is the logic in investment? The logic is that if you do not invest your unused money or your surplus money, then your money will not grow. So in order to grow your money, investment is inevitable. But then why do you require knowledge? You require knowledge to minimize the risk and maximize the growth. If you indulge in investment without proper knowledge, then you may do it otherwise. You may maximize the risk of losing your money, and you will minimize the growth. So therefore, as we proceed, we shall try to dig in more logic and see more knowledge or more reasoning in our investment. Welcome back. Now, once you agree with the logic of investment and you agree that you require knowledge, then the question comes as to what is knowledge and what knowledge is needed for investment. If you just think over, you all must have observed that an apple, when broken from a branch, it falls down. An apple falling down from a branch, or for that matter anything which you throw up comes down, that is an observation. You observe that. But if you have an answer to why it happens, if you know that it happens because of gravity, then that thing is called as knowledge. Similarly, if you have made an investment in anything, maybe property or anything, let us say the stock market, the price of the stocks or the price of the shares keep going up and down. Or for that matter, price of anything, even vegetables, clothes, or anything in the market, the price keeps going up and down. That is an observation. Everybody sees that. But if you could get an answer as to why the price goes up or why the price comes down, if you have an answer to that thing, then that is called as knowledge. Got it? Now, if you are seeking knowledge, if you want to have knowledge, then you need to learn anything. Whatever knowledge you require, you need to learn that thing. And if you are seeking knowledge of investment, then you need to learn the basics of finance. Finance or the basic knowledge of finance is very important before you indulge in any investment. And more important is to know, to understand that accounting and finance are two entirely different things. Most people think that accounting and finance are the same thing. No, they are not. Accounting and finance are entirely different things. To be a successful investor or to get knowledge of investment, you do not need any knowledge of accounting. You don't have to be an accountant. In fact, you require no knowledge of accounting. But if you want to be a good investor, if you want to be a successful investor, then you should have the basic knowledge of finance. Got my point? Not the knowledge of accounting, but the knowledge of finance. And what is that basic knowledge of finance? When you want to learn basic finance, you must first try and understand the difference between savings and investment. Then you should know what is inflation, what are the types of inflation, and how do they affect you. Then you must know what is meant by risk and how to analyze risk. Once you know that, you should also know what is liquidity. Liquidity of your personal assets and also the liquidity in the economy or the liquidity in the environment. What is it? Then you need to understand the time value of money. What is time value of money? What are bonds? What is bond yield? What are coupon rates? All these things you need to know as part of basic finance. You also need to understand the various instruments of investment. What are the investment instruments available to you? And the different ways of converting your money into wealth. All this comes under the basic finance. Then you need to understand, you need to know what is meant by debt, what is meant by equity, what is meant by interest rate, what is stated annual return and effective annual return. All these things you must know. You must know what is capital and what is the cost of capital, what is a turnover in business. Then you need to understand the significance of diversification. Why must you diversify your investment? Or why must all business diversify? And then you need to understand what is profit, what is earnings, what is the difference between profit and earning. All these things you must know. You must know what is EBIT, what is EBITDA, what is ROI or return on investment. All these things you can learn from a good book, or you can surf the net, you can search for free videos on the internet or YouTube. But if you are short of time and you want to learn all these things in a structured manner, then you can look for a suitable course, a well structured course on Udemy. And if you are looking for a course on Udemy, then you may try out this course which I have got on Udemy, which is called as Finance, Investment and Business, the Fundamentals and Concepts. It is a 4.5-hour course with 36 lectures, and it covers all these things and little more than this in a very structured and sequential format. Don't go by this rating. You can check for the current rating at the time of investment or at the time of enrollment into the course. Of course, enrolling in the course is also a form of investment, an investment in knowledge. So we'll see something more in the next lesson. All right. Welcome back. Now let us talk about the approach. You see, once you have understood the basics, the fundamentals and the concepts of finance, investment and business, then you will be able to differentiate between participative investment, entrusted investment and personal asset investment. Participative investment is equity based, in that you can have your private business or it is partnership business. You can also consider stock market investment, investment in shares, and then also some equity based mutual funds and similar other things. When you talk of entrusted investment, here you are entrusting your money to somebody else. That is basically debt. You are giving your money to somebody on loan. Here you can consider fixed deposits, the company deposits, the government bonds or the treasury bills, then debentures, debt mutual funds, and similar other things. And when you consider the personal asset investment or ownership of certain things, in that you can consider real estate, gold or some precious stones. You can invest in commodity, crude oil, currency, some antiques, and similar other things. All right. So you will be able to differentiate between them. You will also be able to decide as to how much liquidity you want in your investment. And then you will also know, or you will be able to decide for yourself as to how much risk you can take, whether you want a fixed return or you want a variable return. So a clarity of mind will be there. All that clutter in your mind, that will get sorted out, and you will have a clear picture as to what exactly you want to do. Now let us say, after analyzing all these things, after going through that, you decide that you want to invest in the stock market. So if you want to invest in the stock market, then you will need to learn something about the stock market. What is that? First is that you need to understand the stock market as a play field. That means a broad understanding of the stock market. In that you would need to understand what a share is or what a stock is, the concept of the share, what a capital structure of a company is. Then you need to understand the initial public offering and the follow-on public offering and how they are priced. Then you will need to understand what a primary market is, what a secondary market is, and what is the difference between them. Then you will also need to know what a depository participant is, then how a trade happens on the stock exchange, and so many other things related to the stock market you would need to understand. Once you understand that, then you need to understand who the players are there in the stock market. When you talk of stock market, there are not only investors, there are traders also, there are arbitrators, there are hedgers, there are foreign institutional investors, there are domestic institutional investors, then there are high net worth institutions or high net worth investors. Then there are speculators, there are gamblers, there are players behind the curtain, people who don't come in front but they play from behind the curtain. Then you need to understand why there is price fluctuation. What is the logic of price fluctuation in the stock market? Similar other things you will need to learn about the stock market. Then you will also need to understand the rules of the game in the stock market. First of all, you will have to select a role. What exactly you want to be? You want to be an investor or do you want to be a trader? Then you need to understand the significance of various analysis. Then you also need to understand various stock parameters and the ratios. Then risk management is an important aspect which you would need to know. Then you will also have to understand some derivatives like the futures and options and how do you trade in futures and options. Then also what is hedging? Hedging is an important part of investment. You would need to understand that. And so many similar things about the stock market you would need to understand. Now the point is that all these things you can learn from a good book. Select a good book and in a sequence, in a systematic manner, try to learn from a good book. Or if you want to learn it for free, then maybe you will have to surf the internet, you will have to search some videos on the YouTube, and in a systematic manner you can try to learn from those videos. But if you are short of time and you need all this knowledge in a structured form in one course on Udemy, then probably you can have a look at this course. This is again one of my courses, which is titled The Stock Market for Absolute Beginners. It is a conceptual course for students across the globe. Students from all countries can have a look at this because the concepts remain the same. It is a 8.5 or 8.5 hours course containing 57 lectures and also certain question and answers asked by my students. But remember that this is a basic course for absolute beginners, and don't go by the rating which is given here. This rating is at the time when I am recording this. When you actually want to enroll, the rating may change. So if you want to enroll for this course, look for the rating and the reviews at the time when you want to enroll. Alright, in the next lesson we shall see. So welcome back. Now we shall talk about your choice. Let us say that after going through this basic course about the stock market, you decide to deploy your money in the stock market. Now, once you understand the conceptual knowledge about the stock market, you will be able to decide whether you want to be an investor or a trader. In the stock market, you can either be an investor or you can also be a trader apart from other things. Okay? Let us say that you want to put your money in the stock market, you want to purchase some shares, and then you want to remain invested in those shares for more than 3 months. If that be so, then you can call yourself as an investor. If you purchase some shares and you remain invested in them for a period of say from 3 months to 12 months, then you can call yourself as a short-term investor. But if you choose to remain invested in a particular share for more than 12 months, then you can call yourself as a long-term investor. But suppose you want to put your money in a stock or a share and you want to exit before 3 months. That means you have purchased some shares but you don't want to remain invested in those shares. You want to sell them off in less than 3 months. Or you want to indulge in frequent buying and selling of shares. Or maybe that you want to indulge in selling before you actually buy. Now remember, in a stock market, it is not necessary to first purchase, wait for the price to appreciate and then sell. You can do it otherwise also. You can sell when the price is high and then repurchase when the price becomes low. If that is what you want to do, then you will have to call yourself a trader. So once you have decided whether you want to be a trader or an investor, accordingly you will have to pursue your learning, because the trades or the learning required for an investor and a trader are entirely different. If you want to be an investor, then you will have to learn fundamental analysis. But if you want to be a trader, then it is not necessary for you to learn fundamental analysis. That will not be of much use to you. But you will certainly have to learn technical analysis. Got the point? So accordingly, once you have decided whether you want to be an investor or you want to be a trader, then you can pursue your further learning. Alright? So welcome back. Now let us say that after going through this beginner's course, a conceptual course, you decide to be an investor in the stock market. You have analyzed the pros and cons of being a trader and an investor. You have decided that based on your risk appetite, you want to be an investor. So therefore now, before purchasing shares of any company, or for that matter, before investing in any business, you will have to do the fundamental analysis of that business. And to understand what fundamental analysis is, let me show you an extract of one of the lessons from one of my courses. Let me explain to you in this manner. Let us say that I have about $10,000, or maybe rupees or reals or pounds or yen, whatever, and I want to deploy that money in the stock market. See, I'm using the word deploy. Alright. Now, if I have to deploy my money, I can either be a trader and trade with that money, or I can be an investor and invest that money. There is a difference between trading and investing. What is trading? What is investing? That we have studied in our basic course that was about the stock market investment and trading for absolute beginners. We have done that. All right. So if I am a trader and if I want to trade with my money, then I should know technical analysis. Technical analysis would involve learning the candlestick charts and patterns and also monitoring various technical indicators and signals. But if I want to be an investor and if I want to invest my money for a long term, then I should know fundamental analysis. And fundamental analysis would involve doing industry analysis as the first step. Then I'll have to do company analysis. And thereafter, the most important part, that is the financial statement analysis. And within financial statement analysis, I'll have to do some ratio analysis. Now in this course, we are not talking about trading or the technical analysis. So this is out. What we are talking about is the financial statements. And financial statements are all about fundamental analysis. All right. So if I have to do fundamental analysis, if I have to invest my money, then the first thing that I do is industry analysis. Now, what is this industry analysis? It is primarily, asking or answering myself as to which industry should I invest in. There are various industries. Should I invest in a capital goods industry or oil and gas industry or maybe infrastructure? Maybe I invest in chemical industry, food processing industry, or maybe information technology or metals, minings, or maybe automobiles. Which company should I invest in? Now, you see, the answer will depend upon which industry has better growth prospects. I would like to invest in an industry which has got better growth prospects and the industry where the labor problems are less, and also the one where the government is favorable. The government is likely to favor some industries in the future, so I would like to invest in those industries. And then I would also consider whether the industry is dependent on demand pull inflation or cost push inflation. This also we have studied in the first course, which was about the fundamentals and concepts of finance, investment and business. So we know this thing, all right? And there are many other things which are all subjective knowledge. These, the knowledge which I am talking about, this is all subjective knowledge and does not require any formal education. This you will be able to know from the news, from understanding, the general economics and general knowledge. So let us say that I have identified three industries. Let us say these three industries I have identified for investing my money. And first I want to invest in an automobile industry. So doing the industry analysis, I have homed on to these three industries, and among them the top one, first I want to invest in automobile industry. Now having selected the industry, the next thing which I will do is do the company analysis. All right. What is meant by company analysis? Now you see, in my country there are 10 automobile companies. Which one should I invest in? Out of these 10, which one should I select? That process is called as the company analysis. That means I will be analyzing the companies and deciding which one is the best for me. But in this process, I would find it easier to do a rejection process rather than a selection process. Let me explain this. What I would do is, I would reject all those companies, all those automobile companies which do not have a good spoken reputation. Those companies about whom the people do not speak good, those companies I will straight away reject. Then I will also reject all those companies which have a spoiled brand name. You see, sometimes the brand name is spoiled. You talk about a particular brand and people say, oh, that brand. No, no, don't purchase those vehicles. They are not good. So if somebody has developed such a reputation, then I would not like to invest in that company. Then I will also reject those companies which have got only a small market share. Then I will also reject those companies where there are frequent customer complaints. And the customer complaints is a common phenomena in some particular companies. So I would not like to invest in those companies. But let us say after doing the company analysis, out of these 10 companies which are there in my country, I would reject 4 of them straight away and I have shortlisted 6 out of them. Now from these 6, I will have to choose which one is the best for my investment. Now remember, I am investing my hard earned money. If I am purchasing even 500 shares of a particular company, and let us say if the company's capital structure comprises of 500 million shares, out of these 500 million shares, if I am purchasing 500 shares, then I become 500 divided by 5 million, that is 0.0001% owner of that company. Remember, because I am investing, I become a stakeholder in that company. And so I will be very, very cautious and I will look at the financial health of that company. Now, having done the industry analysis, the company analysis, now I will read, understand and analyze the financial statements of each of those 6 companies which I have shortlisted. And I will do the analysis not just for the current year but for the past 5 years. Now what are the financial statements? You see, there are basically 3 financial statements: the balance sheet, the profit and loss statement and the cash flow statement. These are the 3 financial statements. The balance sheet will tell me how much wealth the company has as on date. What is the status of the company's wealth today? And it will also tell me, by reading the past 5 years balance sheet, it will tell me whether the company's wealth has increased, decreased or remained static over the years. And then the profit and loss statement will tell me whether the company is running in profit or is it running in loss. And if it is running in profit, has the profit increased, decreased or remained static over the past years? And then when I study the cash flow statement, the cash flow statement will tell me where the money is coming from and where the money is going. Whether the money is coming into the company from its core business. If the company is manufacturing automobiles, is the money coming in through the sales of automobiles or has the money come in through borrowings by taking loans or by selling the assets, selling the plant machinery of the company? How has the money come in? The company may be running in profit, but is the company properly, judiciously, wisely utilizing the money or not? That also will be revealed by the cash flow statements. Alright? And then, having studied the balance sheet, the profit and loss statement and the cash flow statement, now I will do some ratio analysis. Alright? The ratio analysis will be done to determine out of those 6 companies. Individually, I have done their analysis of the financial statements, but to compare among themselves and decide which is better than the other, I have to do the ratio analysis. How do they compare with each other? Which one is better valued today and which one is likely to be better valued in the future? Which one is growing faster than the other? Now you see, some company may be good today, they may be giving huge profits today, but will they continue giving the same profit later? Some other company may not be giving profits today, but is it possible that they will give huge profits tomorrow? Consider an example that there is a tree laden with fruits. It is giving good fruits today, but it is in the process of dying down. Maybe in a couple of years, the tree will die down and will not be giving any fruits. But today, it is fully laden with fruits. On the other hand, there is a plant which is not giving fruits today, but in a couple of years, it will start giving good harvest and it will continue giving harvest year after year. So where should I invest my money? In a tree which is giving profits today but likely to die down soon, or maybe in a plant which is not giving fruits today but will soon start giving good harvest. So that is what I will decide by doing the ratio analysis. And then I will also come to know which company is more risky than the other. And some more answers I will get from the ratio analysis. On my ratio analysis, on the basis of my ratio analysis, I may discard 3 out of the 6 companies. I have been doing this for 6 companies. So after my analysis, probably I may discard 3 of them, and the remaining 3 I may prioritize them as number 1 company, number 2 company, and number 3 company. And then I may invest 50% of my money in number 1 company, maybe 30% in number 2, maybe 20% in number 3, or maybe I will invest the entire amount in the number 1 company itself. It depends. So that is the logical process we all follow to select a good stock or a good share. But please remember that this course, or rather in this course, we will not be doing industry analysis, we will not be doing company analysis, because both of these are subjective and they require general knowledge. These things do not require any formalized courses. In this course, what we will be doing is only the financial statement analysis, and we will do that in detail. Financial statement analysis is an objective study. It is based on facts and figures. We will see that during the course. And certainly it requires a formalized and a structured course. And that is why I have prepared this course. One more thing which you must remember is that you need to take a holistic view. You see, in this course, during the process of the course, I will be talking about various things like, the working capital cycle, the reserves and surplus, the equity, the debt equity ratio, the top line, the bottom line, all these things. You may wonder as to why I am talking about all those things in the course. How are they concerned with buying and selling the shares? But please remember that to get a holistic view or a complete idea of fundamental analysis and the financial statements, you must see all those things. You must know all those things. Do not try to take a shortcut. And then I must tell you that this is not a one-time effort. It is not like you have done the financial statement analysis and then you purchase shares worth $10,000 and then you go to sleep. It doesn't happen like that. Periodically, you will have to monitor every 6 months, 9 months, or maybe once in a year. You will have to monitor, you will have to review, and you will have to see that the decisions which you have taken, the analysis which you have done, whether that still holds good or things have changed and you need to deviate or you need to correct your course of action. So therefore, you have to keep repeating the financial statement analysis at periodic intervals, maybe 6 months. And then you see the results of what you do will be seen after a couple of years. You do the fundamental analysis, you do the financial statement analysis today, and immediately the result will not be seen. The result will be seen after a couple of years when the share price increases, the growth take place, and that is the time when you will come to know whether your analysis was correct or not. And you will be doing this analysis not only for yourself but maybe for your friends and family. So you must do the analysis with due deliberation so that a couple of years later those people should come back and tell you that the analysis which you had done was good and the shares which they have purchased have given them good profits based on your analysis. That was an extract of a lesson from my course which is titled Fundamental Analysis, Understanding Financial Statements. So now in the next lesson, we shall talk something about the financial statements. Alright? So once you have decided that you want to be an investor and you have understood the concept of fundamental analysis, then what you need is to learn how to read and understand and analyze the financial statements. Now we have already discussed that these are the three financial statements which you need to learn and do some ratio analysis. So the point is that if you want to learn how to read, understand and analyze the financial statements, then what should you learn and in what sequence should you learn? Because if you learn things in a random manner without a proper sequence, then you might get more confused. Rather than learning something, you will get confused. Therefore, I would recommend that you should first try and learn the balance sheet. Learn how to analyze the balance sheet. And that too, you should learn in this order which I have given, the sequence. First, try and understand what are assets, liabilities, and how they are balanced. Then what is the owner's money and why is owner's money also a liability? Then what all is contained in a balance sheet, a snapshot of the balance sheet you must get familiar with. Then try and understand what is the share capital, what is the debt equity ratio, and what is the significance of debt equity ratio. Then the significance of retained earnings. What is retained earnings? What is reserves and surplus? And what is their significance? Then try and understand the current assets, current liabilities, working capital cycle. All these things are important for a broader perspective. Then you should know how to look at the balance sheet and what to look for in a balance sheet. Another important aspect. Then there is something which is known as a golden rule about a balance sheet. What is that golden rule which every balance sheet must follow? And what will happen if a balance sheet does not follow that golden rule? And having learned all that, then you should learn how to analyze the balance sheet. Once you are done with the balance sheet, then you should look at the profit and loss statement. Get yourself properly introduced to the profit and loss statement, also called as the income statement. Try and understand what is the top line, what is the bottom line, what are the incomes and expenditures explained there, then what is EBIT, what is interest, what is tax. Try and understand the psychological aspects of the top line and bottom line. This is very important. Then try and understand how the net profit is calculated. And then towards the end, try and understand and analyze that balance sheet, or analyze that profit and loss statement which you have looked at. And then after you have understood the profit and loss statement and also the balance sheet, then have a look at the cash flow statement. As I have told you earlier, the cash flow statement will tell you where the cash is coming from and where it is going, whether it is being judiciously utilized or not. In the cash flow statement, you will first learn about the operating activities. What is that? What is the significance? Then the investing activities, then the financing activities. What is the significance of these two activities? How do you read them for the future? Then what are the cash from any other activities? And what is the net cash flow? Whether the cash is coming into the company or going out of the company. You need to analyze all that and what effect it will have in the future. Once you are done with understanding and analyzing the balance sheet, profit and loss statement and the cash flow statement, then you may have to do some ratio analysis. When you are learning the ratios, try to learn what is face value, what is book value, what is the market price of a share, what causes the market price to fluctuate, then the earning per share, the price earning ratio, debt equity ratio, the return on equity, the price to book value ratio, the current ratio, and certain other things you may learn. All this, once you understand and then you analyze, you will be able to select good shares for the long-term investment. Now, all these things which I have told you about the balance sheet, profit and loss statement, cash flow statement, and the ratios, all these things you can learn from a good book. You can also search for them on the internet, on the YouTube. You may find good lessons on that. But all that may take time, and it is important that you look at them in a proper, organized, sequential form. So if you are short of time and if you want to have all these things in an organized manner, in a structured manner, then might as well look for a good course on Udemy. And if you are looking for a good course on Udemy, this is one of them, one of my courses, which is titled Fundamental Analysis, Understanding the Financial Statements. Again, this is a 6.5 hours long course with 46 lessons, and I keep updating them. At the moment when I'm recording this, it is one among the highest rated course, but don't go by that rating. You have to look for the reviews and rating, the current rating, at the time when you want to enroll. And if you find it suitable after seeing some free preview lessons, then you may enroll for that. Alright? In the next lesson, now we shall try and understand as to what you should do if you decide to become a trader. Alright? Alright. So in the previous lesson, we have seen that if you want to be an investor, then you need to follow certain approach. You need to understand fundamental analysis, and then you need to learn about reading, understanding, and analyzing the financial statements. All right. But some people may not want to be investors. They may want to be traders. They may want to buy and sell the stocks at a good frequency. Frequently, they may want to do that. Though I personally do not recommend that you do trading before you learn investing. In my opinion, a person has to be an investor first. And if he is a good investor, then only he can be a good trader. But just in case, if you choose to be a trader in the stock market without learning about investment, then there is nothing drastically wrong in that. You can do that. If you want to take up trading as a profession, then by all means you can do that. In that case, you will have to learn some technical analysis. You may have to learn to read and understand the candlestick charts and patterns. And then most important is that you will need to learn derivatives like futures and options, because I have seen most people trading by buying and selling shares. That is not very advisable because you spend a lot of money in brokerage and taxes. If you want to do trading as a profession, then the right way to do trading is through the use of futures and options. All right. But trading is not very simple. It is a profession in itself. So you have to learn it properly like a profession and then do it. Futures and options are not only complex things, but they are quite dangerous. If you indulge in them without proper knowledge, then they can destroy your capital in no time. So never commit the mistake of indulging into trading without proper knowledge. There is no substitute for a structured training under a qualified instructor. Now you may try to learn by reading books, by looking at videos on the YouTube over the free internet. These things can help you, but there is no substitute for a structured learning in case of if you want to become a trader. You may even try out expensive trading programs and coaching. I personally do not recommend such programs, those expensive programs conducted by traders. A trader may teach you what he or she is actually doing, not necessarily what is right and proper. This is a subject, a profession which has to be learned, and it has to be taught by qualified people. I have seen people who are traders, they themselves start teaching without explaining the fundamentals and concepts to the student. That is not advisable. So now if you want to try out some inexpensive structured courses on Udemy, you can look for some good courses on Udemy. I too have my courses on Udemy on these subjects. You can try out this course titled Futures Trading. It gives you a complete understanding of the stock futures right from the basics. It explains to you the concept and how the futures are to be used. It is a 6-hour long course with 42 lessons, a very comprehensive course. Just don't go by the rating, current rating. If you intend to enroll, then look for the rating at the time when you want to enroll. Then this is another course which is about options trading. Again, a very comprehensive course which gives you a complete understanding of the options right from the basics. It does not actually, teach you only the trade. It explains to you the concept and the theory about options, what options actually are. Again, at the moment, this is the highest rated course on Udemy, but don't go by that. At the time when you want to enroll, it may or may not be highest rated. So have a look at that time. And if this you want to see the candlestick patterns, then this is one of the good course, a 3.5-hour course with 24 lessons. This explains to you how to read the candlestick patterns, especially to understand the trend reversals, which traders would find, very useful. Again, a very comprehensive course. Then this is about some practical trading strategies in futures and options. It is for the beginners. Once you learn the basics of futures and options and the candlestick patterns, then some simple practical strategies you may try out using this course. It is a 3-hour course with about 19 lessons. Quite a high rating at the moment, but again, as I repeatedly say, you have to look at the reviews and the rating at that time when you want to enroll. Now you see, there is always a desire to do self-learning by surfing the internet and looking for free videos on the YouTube. That is not wrong, but particularly in case of trading, if you want to learn trading on the stock market, then I would not recommend that. If you want to learn trading, then you must learn it under a qualified instructor through a proper structured course. Not necessary that you have to take up my course. You can search for any good course on the Udemy platform or maybe any other platform. But my advice is that you must go for a structured course. But just in case you choose not to take up a structured course and do self-learning, then in the next lesson what I will do is I will illustrate the sequence and the name of certain topics which you must look for when you are trying to learn futures and options on your own. Alright? So welcome back. As I told you in the previous lesson, that just in case if you want to learn derivatives on your own, that is if you want to learn futures and options on your own, then how should you go about it? What is it that you must look for over the internet or on the YouTube? If you intend to learn it by yourself, then you must first learn futures before you take on options. Options may appear very simple, but they are not. Many people try to learn options first, or they try to learn only options and not the futures, because options can be purchased at a very low cost. But that is not the way to trade in derivatives. A thing which is available very cheap, not necessarily that it is a profitable thing. Buying options at a low cost is a guaranteed recipe for losing your money. So you must understand the futures first, and if you understand the futures well, then understanding options become comparatively easier for you. But how should you go about learning futures? What is it that you must look for? You must first try and understand the meaning of derivatives, the literal meaning of that English word derivatives, and its relevance in trading. Unless you understand the meaning of this word very clearly, you will not understand the further gambit of it. And then try to understand the different types of derivatives, including forwards. Forwards are obsolete in most of the countries now, but they are an important part. Understanding forwards will make understanding futures much easy because futures are born out of the forwards. Then try to understand the literal meaning and the concept of future trading in context of stock market. Then try to compare the forwards and futures, and then you will know why futures are a refined version of forwards. Then try to think what is the difference between trading in a share or shares of a company and trading in future. Once you understand that difference, the concept of futures will become much clearer to you. And now probably once you have understood what forwards and futures are, then probably you can take a notional trade in futures without involving any money, just for fun. You can look at a notional trade or a dummy trade on YouTube or some other platform and try to correlate your understanding with that. And while you are doing your notional trade without any money, during that period, try to find out what is margin money and what is the significance or why do you need margin money in future trading. Then search for the various terminologies associated with futures. Try to understand what is the spot price, what is the future price, what is the difference between them, what do you mean by near month, middle month, and the far month in context of future trading. What do you mean by the last traded price? What is the cost of carrying a futures? Then try to understand what does it mean by going long, going short, short covering, long unwinding. All these concepts you must understand very clearly. You must also understand what is contango and what is backwardation. And thereafter you must also understand what is meant by arbitration. Then try and find out the meaning and the relevance of the word breakout. What is a false breakout? Then what is a whipsaw? How is it dangerous? How should you safeguard against that? All these things you must try and learn. Surf the net and try to find out all these things. Then what is the difference between the spot market and the futures market? How are they correlated? That you need to understand. Once you are done with that, then comes taking the risk or the risk management. Risk management is a very important aspect of futures or any derivatives for that matter. You must try and understand the difference between market order and a limit order. Why do you place a limit order? Then also try and understand the meaning of what is stop loss and what is a stop loss order. Then try and understand how to minimize your losses if your trade goes against your analysis. Sometimes you may analyze something and take a trade, but the trade may go against your benefit. What you have perceived may not happen. The other thing may happen. And sometimes when you are in profit, then how should you protect your profit? Most of the time you will see that it happens, you are in a profit, but suddenly then you enter into a loss. How should you protect your profit? That you must know and understand. Then you should understand what is a naked position and a covered position in context of a future trade. Then think over as to why you should always be in a covered position. What is the danger involved if you are not in a covered position? How can you be ruined if you try to be greedy and do not cover your position? Then towards the end, you must try and understand what is hedging. What is the literal meaning of hedging? And what does it mean in context of derivatives, especially in context of futures? And then you should try to understand the significance and context of derivatives, or rather the significance and context of the word hedging in relation to your portfolio or in context with your portfolio. Then look out for the logic of hedging, that why must you often do hedging? Just try and understand the logic of that. Then think over that, can you generate some income in the regular process through the use of hedging, or by the employing the tactics or the employing the strategy of hedging? Can you generate some income? Look out for some live trade demonstrations on the YouTube or any other platform. Do not commit your actual money in the beginning. Look out for demonstration trades or some mock-up trades like that. Do not commit your own money, your real money, unless you are very, very confident. And do not commit your money unless you have covered your position with a stop loss or a counter position. Being naked in the derivatives market can be disastrous. Never, never, never speculate when you are trading in futures. Always cover your position, manage your risk properly. Alright. In the next lesson, I shall try and explain to you as to what should you look out for when you want to learn options. Alright. Okay. Once you have understood futures, then you can take on options. But when you start learning options, what is it that you must look out for? Or what is the chronology or the sequence in which we should learn option? First, you must try and understand the literal meaning of the word option. It is a simple word. Look for it in a dictionary or search on the Google. Try and understand the meaning of this word, meaning of this English word, options. Then think over, why should there be options in the stock market? Once you understand the literal meaning of this word, then you will be able to think and question yourself as to why should there be options in the stock market. I can say with quite a certainty that a large number of people who trade in options do not even know the meaning of that word in context of what they are doing. Then you should get to know the difference between calls and puts, call option and put option. What is the difference between buying calls and selling calls? What is buying puts and selling puts? Never try to mug up or even look at the definition of these things. Definition of options, calls and put. I have never seen a definition more complicated in my life than the definitions of options, the call options and the put options. So I never try to teach the definition of these words. Try to understand the meaning, the theory, and the context of these words, why they are used, where they are used, how they are used. Forget about their definitions. Then try to understand the concept of trading in option. What is it? Why do people trade in options? Were the options really meant for trading, or were they meant for some other purpose and people have started trading in it? Try and find answers to these questions. Thereafter, you should try and understand what is an option chain. When you look at the screen of your monitor or when you are trading on your platform, try to find out the meaning of the option chain. What is it? What is its relevance? Then what is the strike price? Why are there many strike prices when you want to purchase an option of one particular thing or one particular stock? Then you will find there are tens of options available to you. Why are there so many options? Then what is the significance of the strike price? What is the time value and the intrinsic value of the options? First of all, try and understand what is time value and what is intrinsic value, and then what is the relevance in option. What is the significance or the practical aspect of time value and the intrinsic value? What is the meaning and the significance of these words? At the money, out of the money, in the money, all these things in context of call and put options, what do they mean? Then when does an option start making money for you and when does it become zero? This you should try and understand. Surf the net, find answers for these things. Try to understand the profit and loss in a call option and a put option. These two are opposite things. Profit and loss in a call option and profit and loss in a put option are entirely different. How are they different? Try and find answers to that. Then what are the choices available to an option trader? If you want to be an option trader, then what are the choices available to you? What is an option premium? Why is an option buyer required to pay a premium? And why does the option seller take the premium? Then learn how you can do hedging with options. What is the risk involved in buying and selling options? And what is the risk in selling an option, especially? You see, when you try to learn options, you will find that buying an option has got a very, very limited risk, a very limited loss. And selling an option has got unlimited risk. If you sustain a loss by selling an option, your loss could be unlimited. So why is that people are selling options? If it is so clear that buying has got very limited risk and selling has got unlimited risk, then why are people selling? In fact, buying and selling will happen only when there are equal number of those two people, people who want to buy and people who want to sell. Who are the people who want to buy options and who are the people who want to sell options? Try and understand that. Then can you use futures and options in combination? In fact, futures and options are meant to be used in combination, though you are studying them separately, but ultimately you will realize that they have to be used in combination. How and why? Why do small traders generally buy options and big players generally sell options? It is an interesting question. It is not, a rule of law or a thumb rule that small traders should always buy option and large players should sell option. It is nowhere written like that. But when you look in the environment, when you see, you will always find that small traders are generally buying options and big players are generally selling options. Though selling involves unlimited risk and buying involves very limited risk and unlimited profit. It sounds very good, but it is not as simple as that. If selling options involves unlimited risk, then what is the logic in selling options? Why do big players sell options? Then once you are done with all these things, then try to find out what are option Greeks, what is their relevance, what is implied volatility, what is the relevance of option Greeks when you are trading options. Then try to understand the meaning and the relevance of these Greeks. Delta, gamma, theta, vega. What are these? There is one more Greek which is called as rho, R-O-E. I have not mentioned it here because I don't consider that to be very important. You can overlook that. But these four Greeks you must know. And a word of caution, never try to mug up the definition of these Greeks. You may just read the definition once and then try to understand the theory and the meaning and the relevance of these things rather than mugging up the definition. When you are sitting in front of your screen to trade, nobody is going to ask you the definition of the things. Once you understand these things, you will be able to take appropriate decisions. And then towards the end, one more time, I would like to caution you that when you are trading in derivatives, be it futures or options, do not trade with real money unless you are fully confident. And when you are trading in options, never sell options unless you have covered your trade. Never, never, never speculate when you are trading in options. Do not try to gamble. These are not gambling tools. They are scientifically designed financial instruments. Make a proper use of them. Do not make them a gambling tool. That is all what I have to say about the derivatives. All right. So welcome back. Now let us talk something about the mutual funds. You see, some people may want to participate in the stock market, but they may not have adequate time to learn about the stock market, or they may not have the inclination. So people think that if you know nothing about the stock market, if you don't even want to learn about the stock market, but still if you want to participate, then the best thing to do is take the mutual fund route. Now, this is not incorrect, but this is half truth. Indulging in anything without knowledge is not advisable. By all means, you may participate in the stock market through the mutual fund route, but not without knowledge. You may do whatever, but if you do it without proper knowledge, then it is very likely that you will fail. So, what should you do? What do you need to know before investing in the mutual funds? See, you need to know certain things, and you need to know them in this chronology. You need to understand the concept of mutual fund, the meaning and the relevance of the word mutual and the word fund. What do they mean? Then you need to understand what is an AMC or the asset management company and the relationship it has with the mutual fund where you are investing. Then you need to understand the concept of net asset value or the NAV as you call it. Then you also need to understand the difference between transacting in a share and transacting in a mutual fund. These two are entirely different things. Then you also need to understand that there is something called as the management fee and the expenses associated with the mutual fund. Most of the time, you are paying the management fees and the expenses, but without even knowing. You just sign on the fine print and you don't even realize that most of the time. And then you need to understand the difference between direct mutual fund and the regular mutual fund. Again, these two are very different. What is the difference? Which is advantageous for you, which is not? That you need to understand. Then you need to understand what is the difference between a dividend mutual fund and a growth mutual fund. Then this I've already told you that what is AMC and the relationship with the mutual fund that you need to understand. Then classification of mutual funds based on various aspects. The mutual funds are classified into various categories. You must know that. Then you need to understand how the mutual fund performs and whether you can do anything about it. You need to know about whether you can really identify a good mutual fund or you just have to leave it to the luck or the mutual fund managers. Then you need to understand whether the asset under management has got any significance. First of all, what is the asset under management and what significance, if at all, it has got? Then you also need to understand very clearly the concept of systematic investment plan, systematic transfer plans, fixed maturity plan, systematic withdrawal plan. Don't go by these fancy words and what the distributors explain to you. try to understand the real meaning of that, and then decide for yourself whether those things are suitable for you or not. Then you also need to understand what is the entry load and what is the exit load. It may or may not be applicable every time, but then you need to understand that. All right. So all these things you can very well learn by reading books or over the YouTube or over the pre-internet. Unlike learning trading, where I advised you not to go for self-learning, but in case of mutual fund, you can very well do your self-learning by surfing the internet. These are quite simple things. But still, if you want to go for a structured course, then look for a good structured course on Udemy or any other platform. One of such course I have got on the Udemy platform. You can try having look at the preview lessons, and if you like that, you can enroll for such course. The name of that course is Comprehensive Understanding of Mutual Fund as an Investment. It is a more than 3.5 hours course with 21 lessons, and I have explained here in a very comprehensive manner what a mutual fund is and how do you go about investing in the mutual fund. All right. I hope you have enjoyed all the lessons. And just in case you have any questions or queries, you can always ask me anytime. It will be my pleasure to answer your questions. And I look forward to see you through all my courses. Have a nice day.